Jared, what's catching your eye with just under 60 minutes to go?
It's all about the bond market today, and you're spot on with your comments about Powell. There were a lot of expectations going into his session today at noon with the Wall Street Journal that he was going to hint that there might be some relief for the bond market, at least that the Fed was concerned about it. Doesn't seem to be the case. So let's take a look at some charts here. We are off the lows. Now, the NASDAQ had been down, I believe, almost 3%. It's only off about 1.7% now. Here's the intraday price action. You take a look at what's happened so far this week. After Monday, it's been pretty much a steady decline all the way down. And yes, really has to do with those interest rates. Now, we're going to take a look at the VIX first. VIX is elevated off of its highs, but you can see it spiked to a level that we haven't seen since the beginning of February. And all of this comes from the consternation in the 10-year T-note yield. We can see that's up 8 basis points today. That is what's causing a lot of the stress in the risk markets. Anytime you have bond volatility, a lot of times, if it's up or down, it can leak over into stocks. And it's really interesting what's going on with this particular tenor here, the 10-year, because it was only yesterday something happened with the 10-year in the repo market that's not supposed to happen. And I liken it to crude oil prices going negative last year. I'm not going to get into the nitty-gritty about it, but all of this is indicating that there's not a lot of liquidity in the bond market. We have a huge amount of cash that's not only coming into the market now, but also into banks, and they're going to have to decide what to do with it. At the end of the month, they might have to deleverage if Powell and the Fed don't take steps. But we have an FOMC press conference and meeting and decision on March 17th. My guess is Powell is going to be forced by the bond vigilantes to act sooner rather than later.
Jared, that's a great point. To now let's break this down for those of us who don't live every day by the bond market. When we talk about the bond vigilantes, what is it they want the Fed to do? Increase the purchase of bonds or to raise interest rates? I don't think it's raise interest rates. So what is it they're pushing here when we talk about the pressure?
Well, there's been a lot of talk about potentially doing another Operation Twist. So what that means is the Fed has a huge stash of bonds in its portfolio on its balance sheet, and it would be selling the shorter dated ones like Treasury bills for 3 months, 6 months, 1 year, and sell those so that the short-term rates would rise a little bit. And at the same time, it would purchase on the long end. So it's a net even in terms of the total amount that's going on its balance sheet. It's net, but it would take pressure off the long end of the curve. It would also increase short-term yields. And there's something else going on that's also kind of in the weeds, but also worth mentioning. That's because in response to the COVID pandemic, the Federal Reserve allowed banks to take on more leverage. Well, that's supposed to roll off at the end of the month. And if banks have to deleverage into the end of the month, that's going to cause additional pressure in the rates market, and it's going to spill over into equity. So a lot of moving parts here, but suffice to say, the bond market, what they really want is the Fed to simply allow them to have more leverage for a greater period of time, or to take control of these long-term yields and get them back down.
Jared, and also just putting it in more context here for our viewers, we talk about the 10-year yield. Historically speaking, it's still very low. I think everyone understands that. So then when you see a move like today, when we have the 10-year yield, up 8 basis points, yet we're seeing this massive sell-off, or we were earlier in the market, why is that? Is it all just because of the speed that we've seen the 10-year yield climb?
Yeah, it's not the absolute level because, 1.55%, that's incredibly low historically speaking. For decades, it averaged about 4%. Now, what's happening here is a feedback loop. Let's go to the US dollar index. Now, this just took out the February high, and this is actually putting in a multi-month high. Whenever you have stress in the bond market, in the short-term rates market, that spills over and it leads to a strengthening of the dollar. And so when you have a strengthening dollar, that puts additional pressure on risk markets. And so this feedback loop keeps on going until there's some kind of catalyst to ease it. And right now, it's probably only the Federal Reserve that can ease it. What would make the Fed act? Maybe not surging rates unless and until it really spills over into the equities markets. Looks like the NASDAQ may enter correction territory today. That could grab some headlines, but I'll tell you what, if we entered a bear market, Fed will act.